Hi, good evening, everybody, for those of you on the East Coast and probably a little bit earlier, those of you on the West. Welcome to CMTI, the exam prep class. This is for Level 1. This is our last class for the fall session. As you know by now, I'm Keith Applegate, and on the line we also have Carson Dahlberg. And what we tried to do with the last class was try and wrap up and really try and get you into the exam prep mode. And that was the design of the homework, was for everyone to put together a bunch of questions that they think they might see on the exam and put them in a format that we can use for the slideshow. Now, we didn't get too many people submitting, so what we're doing is we're using previous classes, fall or spring of last year and the spring of this past, of earlier this year, and we're going to use those questions that students in those classes provided for us, and we'll go through. We have a number of charts, as you can see at the bottom of the page there. We got 76 of them, and we'll try and run through them really quick because we don't have too many people in the class tonight, but we can get through it and answer any questions that you may have. Also, I loaded last week's class. For those of you who had questions, we can go back real quick, look at a chart and or a concept and go back, because I know we did run through a bunch of statistics that Carson went through late in the class last week, and there might be some questions there. So I just loaded it up for everybody really quick, just in case we need to refer to it. Just a couple of quick notes. If anybody's noticed, the MTA EF has the Take an Analyst to Lunch Day, and they're actually getting some pretty good bids out there. I was actually surprised some people hadn't gotten any bids, and I was going to bid on them, but I'm not able to do so right now. If you go to eBay and you just type in Take an Analyst to Lunch, they have a number of people available, and Ralph Akampura leading the pack. He's got 10 bids at $500 so far, and he's actually in second place. Felix Zuloff, a person who I know through my previous work with Ian Notley, he's got 18 bids, and it's currently $520. A bunch of other technicians don't even have bids. The minimum bid is $300, and there's some great people out there. Linda Bradford Ratchke has one bid at $300. Phil Roth, 2 bids, $305. And as I move up the screen here, John Bollinger, the guy who invented Bollinger Bands, just got a first bid today, or late today, because I looked at about lunchtime and he didn't even have a bid. But somebody's bidding on him, and it's $300. And if you really are a student of technical analysis and want to get, technical analysis, right from the people who practically invented some of the indicators that we use on a daily basis, on our long-term, intermediate, and short-term and intraday charts, it's a great way to get to meet them and have a good conversation with them. Other than that, I know the exam's coming up later this month, and we're hoping that everyone's really enjoyed the class, and we've prepared you well enough to be able to speak on a definitional level, that you can converse with another technician. You won't have to explain yourself to a technician what you're doing unless you're building a brand new concept, but we'll go on from there. Again, today's agenda, class will focus on answering multiple choice questions of related material for the Level 1 exam. So if you will, grab a pen and paper and score yourself, and then when you get the question wrong, write it down, write down that topic to review later, and then if we have any time during the class or even after class, you can ask questions, and then Carson and I could either answer it or go back to like a previous class and show you the chart of what we're looking at. So I'm not really going to read these to you, so we're just going to put them up for the next, 15, 20 seconds and go from there, and all you got to do is just type in your answer in the meeting chat box. So here we go with the first one. Okay, I don't see anybody typing their answers into the chat box. Okay, there we go, Andrew. Thank you. Thanks, Brett. Robert, sorry, I saw your last name. And thanks, John. Okay, which term least likely belongs to the following list? And the answer is D, the trap. It's considered a false breakout, and it's explained there in Pring and Kirkpatrick. All the others are patterns that we see in technical analysis, and that they do have rules that they follow, and if they fail, obviously the pattern has to come into question. So the consolidation pattern that you will see mid-trend, for the continuation pattern, your flags, your pennants, if you will, and then the corrective phase. That's one of the Dow phases. So the answer there is D. On to the next one. So which of the following would not be considered a continuation pattern? And that's C. That's the common gap. And those frequently occur in illiquid trading vehicles, when they're small in relation to the trading that they appear in very short-term trading data. When you're looking at something that just is pretty illiquid, something that is a very high-priced stock, where it takes quite a significant amount of money for someone to buy a round lot, or something, that may trade pretty well, over the course of a day, but, has like a gap of 4 or 5 minutes in the trading, as they wait for orders to come in. That would be what would be considered not a continuation pattern. A downward sloping flag in an uptrend is the classic. The pennant, which I mentioned earlier, and then the rising wedge, certainly in an uptrend, would be considered continuation patterns. So negative divergence in the AD line would likely signal market top, Kirkpatrick. He talks about negative divergence when price moves to a higher high and the indicator makes a lower high. So when we have the AD line making a lower high and price continuing higher, less and less securities are supporting a rally. Therefore, it signals a weak market internally and that a rally may end soon. On the flip side, this is an example of what Ralph Acamporo usually always talks about going into the 2000 peak. Markets kept going higher, and it just kept getting narrower and narrower and narrower. Where in the technology space was the only leaders. Everybody else was falling away. That was the signal for the bear market in 2000. The leadership just kept dwindling and dwindling, and he said the exact day that we hit a peak in the market was the exact day we hit a bottom in the stock in the AD line, and we had the stealth bear market. But in this case, we're looking at divergence. So when we do have markets going higher, but on less and less, not a clear bottom, a major bottom in the AD line. You do get that negative divergence where price continues higher, but the indicator does not support it, and that would give you a market top.
One thing also, just real quick, is one way to think about it as well is just that it's less and less stocks pulling their weight and carrying the markets higher.
Yeah, and I think one also giveaway in that question, too, is negative divergence. So it certainly wouldn't be a market bottom. You know, when we're talking about positive divergence, we're talking about things that are, moving higher. So. You know, on the practice test book, say the questions are easier than the test. Good gauge for the difficulty level of the questions. Well, the difficulty level probably runs the gamut from quite easy to quite hard. But remember, anything that's definitional is fair game for the exam. So questions like these are things you could see. But for people that, have studied really hard, certainly like I did, I put incredible amounts of time and energy into studying, and I passed all 3 levels all in the first exam, first try. So if you do that, this may seem a little bit light and fluffy, but these are the type of questions you can see. Would the Pring study guide be a good benchmark? I don't have the Pring study guide, as there was no study guide for the Pring book back when I was taking it, but the John Murphy study guide was a very, very good benchmark for the questions you would see on the exam. So that's why I keep recommending the Murphy Technical Analysis of Financial Markets study guide. I think that's a better use of your money if you're looking for something that's going to give you a good benchmark for what's on the exam. You're welcome, Andrew. All right, next one. Okay, the higher level in the ARMS index would indicate that B, the number of advancing issues, is rising. The ARMS index peaks at market bottoms and bottoms at market peaks. So a high level of the ARMS index would indicate a number of advancing shares is occurring on low volume. Yeah, which of the following is one of the 3 essential branches of technical analysis? Trends may seem obvious, but according to Kirkpatrick, the 3 branches of technical analysis, sentiment, flow of funds, and market structure indicators, is the best answer.
Yeah, I think real quick, what Keith said is look for the best answer. Sometimes there'll be some that they're not intending to trick you, but just there'll be 2 that are really close front runners. So if you can kind of use a little bit of process elimination, you can kind of whittle it down. Like, for example, C, you wouldn't be able to eliminate sentiment as a form of analysis, but trends can kind of fit in to different areas.
Yeah, futures and stocks are just the vehicles of which to trade with. So you could eliminate B and D right off the bat, but then you got to haggle over A and C. Yeah. Which of the following terms describes a move which has a duration of short as a few weeks or as long as a few months, and that is the intermediate cycle. And remember, the intermediate cycle is measured normally in weeks, but it could be measured in months. The short cycle, what we're talking about is the short-term cycle, is measured in days out to weeks, and then the primary cycle, the 4-year cycle, is measured in months out to years. Super cycle wave 3, that's obviously an Elliott wave structure, so it's not really the best answer, but the best answer here is C. What's the cutoff for a minor move? Well, normally things are just measured in days for minor moves, out to weeks, but if you see something more than 10 weeks, I doubt to say that's a minor move. That's more of an intermediate move. Andrew, I hope that helps. Okay. Yeah, risk can be defined as all of the above: the variability of the returns over a time frame, the amount of loss per trade when you're doing some back testing, and then the drawdowns. From your peak to your trough, how far down do you go? Because going down 10%, you don't go back up 10% to get to even. You actually have to get 11% return, and that number grows every 10% you go down. 20% down, you got to go up 25% to get back to even. 30% down, you're talking, I don't know, was it 41%? And that number just grows until I know you get 50% down, you need 100% return. That's drawdowns, and that's analysis of drawdowns, and that's certainly something people look at when they're looking at risk in terms of their technical calls over time. So, which of the following can be used to minimize losses from a bad trade? Certainly could use any one of them, but the best answer there, again, is all of the above. Trailing stops, money stops, trendline stops, chart stops, they're also called chart stops. Certainly things people put on to help minimize losses from, say, a bad trade. Trailing stops, you say, buy a stock at 50, you want to keep your losses to a minimum, so you put a $2.50 trailing stop. So your stop's at $47.50 initially, and only ratchets up from there on out. A money stop, certainly having to do with the amount of money you are willing to lose in any trade, and then a trend line stop, using a chart to say, hey, something's in a trend, been trended, and I don't want to lose that trend line support, so anytime you break it, that will be your trend line stop. Okay, volume spike is most common at confirmation of a breakout. That's from Martin Pring's book, page 92. Volume spikes they happen at the beginning and end of trends, but certainly don't always, or are very common, the most common, at the confirmation of a breakout. So which of the following are index oscillators of price data? And that answer is D, meaning A and B, RSI and MACD. Rate of change is certainly something people look at, but it's not necessarily an index. It's not bounded by 0 to 100, if you will, for RSI. And then it's not necessarily an oscillator, like you have two moving averages moving in different directions from one another. Rate of change could potentially stay high and continue higher, and then I guess it is bounded by 0 or 100, negative 100 on the bottom, but it's really not an oscillator as described by technical analysis. Yeah, so the point at which buyers become as powerful or aggressive as sellers and price stops declining is C, support. And that's ultimately what technical analysis is, because with every trade you have buyers and sellers, but are the buyers more aggressive or the sellers more aggressive at a certain point? That gives you your price changes, but then when buyers become as powerful or as aggressive as sellers at a certain point and price stops declining, that would be support. Opposite, when price is advancing, that would be resistance. Certainly peak and trading range is in there. Certainly peak is not, but the trading range is in there to maybe stump you if you just glanced over the price stops declining part of the statement, so you can eliminate those two. Certainly, the concept of support and resistance presumes that in the future prices will stop at these recorded levels / zones and that they represent what type of barrier for price. They're really psychological, and think about what's happening with the trader or investor at that time frame, if it's a longer term chart, if you will. They certainly have good prospects of buying a certain stock or a bond, and price goes in the opposite direction of what they think of, and the thoughts are, man, if I can only get back even, I'd get out, and that gives you your resistance area. So anytime the price gets back up to that major resistance point, and especially when you see large gaps on charts, when you get up to that point where you're starting to fill the gap, that's when you see psychological support and resistance come into play. And that's when charts tend to play bigger influences into how something is trading than the fundamentals over the longer term. So yes, psychological is the correct answer. Yeah, point and figure charts embrace which of the following components, and that would be price only. They ignore time and they ignore volume. If something is trading at a certain price, say $30 for weeks, months on high volume, on low volume, you're not going to record another X or another O, depending on what type of column you're in, unless that price moves a point or more, if you will. Yeah, it's price only based charting. Ignores volume and ignores time. So yes, price is the correct answer. certainly the box size in a point and figure chart refers to, that answer is B, the number of points or a monetary value assigned to a square on the grid of a point and figure chart. For people who might have read the question a little bit too fast, they thought it would be A, but that's not. That's the reversal, like a 3x1 chart or a 3x3 chart. You have to reverse by 3 boxes to begin a new column. Right, reversal size. Here you go, Eric. Yeah, so the reversal size of a point and figure chart refers to the minimum number of boxes that must be filled in the opposite direction for a new column to begin. So when you're at $30 and you're in a 3x1 box point and figure chart, you've got to go down or up, if you will, by 3 boxes to begin a new column.
I think real quick, these last 3 examples are kind of the kind of things where people tend to get hung up on is they read through too quickly because they're nervous and instead of reasoning through what they're asking for. And on top of that, think about the book answers versus what you might do in real life as well. So just food for thought when you're taking the exam. Remember to carefully read everything.
I guess, leaping off of what Carson was saying is when the answer here, letter A, the minimum dollar value, we would actually expect to see what is the dollar, what's the box size and the reversal size of the point and figure chart. They would give you that. It's 3 by, and it's a $5 box chart, so it would be $15, the minimum dollar value that price must change for a new column to begin. But here, when we're talking about the reversal size, we're just talking about the boxes in general. Yeah, sell signal is generated in a point and figure chart when, and that's C, column of O's fall below a previous column of O's. Well, right off the bat here, you can eliminate 2 of them because on D, X's fall, no, X's rise, and then O's rise, no, O's fall, so B and D are out. So it's certainly a column of O's falling, and you just got to know what really the book is talking about. And a sell signal is when a column of O falls below a previous O column. So in the example we're talking about here, when O's fall below that 30, say 30 was a support level from a previous column of O's, then when it falls below that O column, that would be your sell signal. Yeah, certainly. Which which type of the point and figure charts is most widely used today, and that's the 3-box reversal. I love what letter D says, just box reversal. All right, I hope people are understanding where they might be just reading things a little bit quickly here. Consider we're looking at a 3-box reversal chart with a box size of 25 cents. Price currently in an up column, so that's a column of X's. You're at $18.50. what will it take for a new column of O's to form, i.e. down, and how many boxes will be filled in on the chart. Well, if it's a 3-box reversal chart, you automatically know it's 3 boxes will be filled in with O's. So automatically you know it's A and D. And then when you're talking about a column of O's, you know it's up to the downside, so you automatically know it's D. Letters A, B, and C don't work because you got 1 box and then you got a price above where you're trading in letter A. So this just by a process of elimination, knowing your definitions, you'd get this answer quite easily and get it correct on the exam. What's the difference between measuring off a point and figure chart and a bar chart? For this one, you need to know how things are measured on bar charts, really, because point and figure charts, we tend to know them, that they measure off of a count. And by count, bar charts are generally based on height. It's the height of the candle, the height of the flag, the height of the flag, the height of the pennant, the height of the neckline to the head. So it's really generally off of the vertical chart, but here, point and figure, you're measured off of a count. So knowing that point and figure, are bar charts ever with? No. So that really is an incorrect answer. It's there to throw you off the track, but point and figure charts always measure off a count, be it a vertical count or a horizontal count. Okay, which of the following is a bullish scenario for price? Well, bullish, we're talking about things that rise, so first one doesn't work. So you're left with B, C, and D, and then you just got to look at what's going on in the rest of the sentence. Column of X's rise above a previous column of O's. Well, that's kind of hard because the X's would be already higher than the O's, so B would be trumped by C, and then a column of X's rises above a previous column of X's and tests resistance. Well, testing resistance really isn't a bullish scenario for price, so breaking resistance would certainly be better. So answer C here, by the process of elimination, we find that C is the best answer for us. I hope this is helping everyone get back into like the test-taking mode of just, you don't have to know everything, but by process of elimination, you can certainly get the answer pretty quickly. A lot of point and figure questions. Is that going to be similar to the exam? Well, yeah, point and figure gives us a lot of questions to test on, and a lot of ways you can, I guess, stump people, if you will, just by the wording of the question or a wording of the answer choices. But point and figure is one of the things that is touched upon. We'll have to look back at the previous class to show you the breakdown of the questions again. But yeah, certainly the point and figure is one of the things heavily tested.
I was going to be a little bit more specific. In the left there's a link. You may have to copy and paste it, but it's really the knowledge base. And if you look at that, it breaks it down into domains. So point and figure isn't actually a domain per se, but it'll fall into all kinds of other things. Like if you were to pull that up and take a look at the breakdown, and you can look back on I think we included these on our previous class 1 and 2 slides. They fall into categories that are pretty heavily listed. So construction of charts is 15% of the exam, and so you're looking at about 18 questions. Trend analysis is about 15% of the exam, also 18 questions. Chart and pattern analysis, point and figure, so it could certainly fall into there. That's the biggest weighting, 18% at 22 questions. So there's a couple other things in there that it kind of fits in. So potentially there's a big swath, 40+% of the exam could entail point and figure. But because they're randomly selecting questions, probably you're not going to see, that's not going to be the majority, but it can be heavily in that area because point and figure can cover all these different areas. Hopefully that gives you guys some insight on that. Yeah.
Yeah. Good question, guys. Thanks. Yeah, okay, so Ann's trading a 3-box reversal chart that has 75-cent box size, and the last posting is 1850 and an X. So now, right off the bat, you know it's an up column. So today the stock traded up to 1922 and sold off dramatically to 1718 because the CEO, news came out, CEO stepped down. What's the next posting on the chart? And the answer is D. There's no new posting, and this is where the time and volume don't matter in point and figure charts. So in order for a reversal to take place, the price would have had to trade down to 1625. So your $3 box reversal size and then the 75-cent box size in order for that's for the reversal to occur, and then in order for the another X to be filled on the upside, the price would have had to trade over 1925. So didn't quite get there, and it didn't quite get there on the reversal either. So no new posting would be the correct answer. Certainly. Mike's a CMT and is starting his own equity research business. He's prospecting for clients and sends a mass email to the CMT mailing list. You violate the code of ethics, of course. Right? Remember, this is your shall and your shall nots, and these are give me questions. Just remember, anything that's unethical is probably going to be flagged, and something that unethical is going to be flagged, and something that is, kosher and ethical, will not be flagged. So you're probably going to get more of the unethical questions than you will anything that is ethical. But be ready for them, and remember, just you're going to get about 5 questions, I believe, Carson, correct, on the code of ethics. But remember, these are give-me's, so.
Yeah, there's probably at least 4 questions, exactly.
Yeah. Yeah, if an MTA member who's your friend and is a CMT publishes or makes a statement about a security, whatever it be, stock, commodity, bond, what have you, on their blog that is really misleading to those who read it because the information was not public, the best answer is that he's violated multiple rules of the Code of Ethics. Certainly did not act in accordance with the CMT designation. Probably should have their CMT revoked because they're going to be dealing with powers higher than just the MTA. And yeah, maybe you might see the increasing likelihood of making a profit, but not always. Something I'm studying for is the Series 66 exam, and we had a debate about whether inside information causes you to trade. Well, it may cause you not to trade either. You have a buy on a certain stock, and you don't do it because news comes out. So be careful there. But yes, remember, it's always about the code of ethics. So anytime you do see that in the answer, it's usually the answer. So. Yeah, here on this one, any member or affiliate should really not publish or make statements concerning technical analysis of a security or a market or its components unless, well, they're well known in the industry. Sometimes they should not be making statements. But yeah, the correct answer is that statements must be reasonable and consistent with the available information of accumulated knowledge in the field of technical analysis. Doesn't mean that someone's using the accumulated body of knowledge that we have for the technical analysis and making longer term calls, and people are actually looking for shorter term calls, or they've been consistently wrong, although they're still using very verified indicators that are in the body of knowledge. We're not really talking about their ability to pick stocks or bonds or currencies, if you will. We're really about making sure that they make statements that are reasonable and consistent with the body of knowledge of technical analysis. So that's the correct answer B. Yeah, certainly, which is not an assumption of technical analysis, and that's price action reflects the various intermarket forces coming together to produce random results. It's not why we're here. The basic definitions of technical analysis that price discounts everything. They trade in a trend, or prices move in a trend, and price is determined by the interaction of buyers and sellers, who's supplying and who's demanding. So yes, A is the correct answer of what is not an assumption of technical analysis. Yeah, which is the following is a false statement in regards to Dow theory. Volume is irrelevant. Volume always should go with the trend. When the trend is moving, volume should move with it. Same thing when volume is, or the trend is even in a down move. The volume should pick up on those down moves. Averages certainly discount everything. There are the three trends: the short, intermediate, and primary trend, and then the averages certainly must confirm. Okay, which of the following is a drawback of Dow theory? And all of the above are drawbacks, because it frequently leaves investors in doubt when you have bullish or bearish non-confirmation. The signals that you do see severely lag the market. It may be months, weeks, or months before you get confirmation of one move to another. and it tends to only really help long-term investors because the rules are so geared towards longer-term trading, and were actually written in another era, if you will. Short-term trading was not really as prevalent as it is today, so it really only helps long-term investors is one of the truths of being a drawback for Dow theory. So all of them is the correct answer. Yeah, this one was practically a giveaway. You know that two averages are used in Dow theory, and the only answer that has the two averages is D, A, and C, the industrial and transportation average. Utility average is certainly a very good average, but not used in Dow theory. So if you see an answer that says, I guess letter E, it would say A and B, that would certainly be able to eliminate it because you know the utilities average is not used. So really, this answer should have been really very quick and practically a giveaway. Okay, on this one, you need to know your intermarket connections and relationships. And the answer is that the dollar moves inversely to commodities, mainly because the commodities are all priced in U.S. dollars. Not all, but mainly all are priced in U.S. dollars. So as the dollar goes higher, commodities are cheaper. But when the dollar falls, commodities are more expensive. So that is the best answer. Bonds trend with commodities, or bonds move inversely to equities. The correlation is not exact in there, but the best one is the dollar moves inversely to commodities. Yeah, certainly. MACD compares two EMAs of price of different lengths. Some people would not know that, and they think it's simple moving averages, just reading on through letter B, simple moving averages of volume different lengths. Certainly would be the way to eliminate B and give you your answer of A, just because of the name of what the indicator is, moving average, convergence, and divergence. So relative companies in the same industry would not be correct, and advanced decline lines would not be correct also. Yeah, here the rate of change indicator is an example of price momentum. It's the rate of change over time, be it 30 periods, 50 periods, 127 periods, whatever you're looking at. It's looking at the rate of change from one price point to another. Oscillator divergence, which occurs near the equilibrium line, is B, followed by a sharp move in price. this really needs to be one thing you really need to know from the book from Martin Pring. There's no way to really eliminate answers, but you just need to know that it's often followed by a sharp moving price. Yeah, this one should be fairly easy and almost a giveaway. Open and closing price are equal, and the high and low trades far from the open and close. It is a doji. Spinning top would not be correct because spinning tops usually have narrow high and lows, but a doji is the correct answer. Hammers and hanging mans certainly do not have opens and closes at the same price. Yeah, so the stochastic indicator was created based on which of the following observations, and then that observation is that when you're in an uptrend, prices tend to close near the high of the day, and that is certainly true when you observe the market over many months or many years in trended markets. Tending to close near the high of the day in a downtrend, letter D, not exactly. Does not fall really on a 0 to 100 scale like RSI does. It oscillates around the 0, and to eliminate the terms overbought and oversold, certainly not true either. So it's based on an observation. So that observation is that prices tend to close near the high of the day. All right, in Elliott wave theory, the rule of alternation means, well, when we're talking about alternates, we're talking about opposites. And here we have wave 2 and 4 having opposite retracements. So when you're in a move in an uptrend, 1, 2, 3, 4, 5 versus your correction, your ABCs, 2 and 4 have opposite retracements. So when wave 2 retraced maybe a third of the way and wave 4 retraced 2/3 of a way, the next 1, 2, 3, 4, 5 move, they will have opposite retracements. Wave 2 will retrace about 2/3, and then wave 4 will retrace 1/3. Wave 1 and 3 can't obviously alternate direction. That certainly does not hold true. Wave 3 is certainly not the smallest, is a rule, but not the rule of alternation. And then wave 5 can be projected by multiplying. 1.618 is not the rule of alternation either. All right, which of the following is not a rule of Elliott wave? And that would be answer B. Remember, wave 3 is not the smallest or the shortest wave. That would be the rule. So which of the following is not true of the Elliott wave? That wave 3 is always the longest. Wave 3 can never be the shortest. Wave 4 cannot enter wave 1. And wave 2 never retraces more than wave 1. All right, it's about an hour in, and we're about halfway through, and I don't want to have this drag on, so we might run through these a little bit quicker. But you certainly do stop us if you need to, and we'll certainly answer any questions you have. Yeah, and you got to know what the theory of Elliott wave is, and that, you know, the typical wave structure looks like 5 waves up and 3 waves down. You just got to know this by elimination. 3 waves up and 5 waves down is a typical wave structure, but the most typical is 5 waves up and 3 waves down. Hope I'm not going too fast for everybody, but which of the following is true of moving average crossovers? It's considered bullish when price crosses above a short-term moving average. It's also confirmed by shorter-term moving average moving above the longer-term moving average. So the best answer really here is D. Even though A certainly works, D is the best answer. So which of the following best describes the equity market performance during a presidential cycle? Well, you need to know what the presidential cycle is looking at, and everyone should know that, you know, presidents try and get reelected. So they're trying to push their agenda in their 3rd and 4th years in their term, and I guess the presidential cycle shows that they're usually correct. So when you're in a 3rd and 4th year of a presidential cycle, look for the markets to be up. So the first 2 years, look for the markets to be down. So that eliminates A. The first year is the strongest. That's certainly not true. The market is below average year during the first year of the president's term, posted strongest during the pre-election year, or in the election year would be the best. That would be answer C. Yeah, everyone should know this right off the bat. Pennants and flags, the most common continuation patterns. I guess I don't really need to comment on the head and shoulders or the inverse and the haramis. Certainly not continuation patterns. Yeah, here you need to know the definitions of cycles and things we went over and things I've talked about plenty of times, and that the phase is not the measurement of the separation between the top and the bottom of a cycle. That would be called amplitude. So if you knew the definitions, this question would be a little bit easier because amplitude certainly is the height of the cycle. The period is the time needed to finish one cycle, and then cycles are measured over their period from trough to trough. You can measure peak to peak, but trough to trough is generally how cycles are measured. OBV, which of the following describes OBV? And that answer is A. On days when prices close higher, it's assumed that all of the volume is represented by buyers. Now remember, OBV was created prior to decimalization or trading in pennies. It was more done during eighths and sixteenths, and you had a lot more unchanged issues over time. But now, when you get down into the pennies, you're looking at giving all of the volume to something that could be only a penny higher, which would be unchanged in previous lifetimes in the marketplace. So there's a little bit of a drawback to OBV, but certainly holds true that that was the rule for on-balance volume, that when price goes higher, all of the volume for that day is assumed to be represented by the buyers. Yeah, ADX, something I've been looking at recently with a lot of the market volatility in recent months. It's calculated off DMI in an attempt to indicate what type of market. Well, we know it's certainly a trading range or a trending market, but you just need to know what ADX, when its figures indicate trading or trending markets. And that best answer here is a trending market when ADX turns, a trending market when ADX turns greater than 25. All the other answers don't fit. Excuse me. And remember, that trend could also be trending higher or trending lower, but ADX will rise when it's in a trending market, be it up or down. Yeah, quite a long read for this question, but you're on a 5-point reversal chart, and you're currently in a down column with $20 box size. So right off the bat, you need $100 to reverse. And the last posting was 428. So when some fundamental news came out, and prices were actually pretty good, and they moved up to 535.21 and as high as 547. So what is the best answer you can give here? Remember, it's 100 points to reverse, so the best answer is 528. With a move up to 548, we need to see that print, but we only got to 547.70, so you don't get to fill in that box. So the best box you get here is the 528. Well, here we're talking about gaps, and we know that gaps, when you're talking about always or never in answers, they're usually not true. So when we say here, which of the following is not true about gaps, we're talking gaps are never filled. That's certainly false. We see plenty of times where gaps are filled on charts, so that would be our best answer here. Well, I think here, and I'm looking at Andrew, your response. Duration certainly is very true, but man, the number of times the trend line is touched determines its significance. If you're talking about 4, 5, 6, 7 times it's been touched, I think that's more significant than duration. When you look at rates for the 30-year long bond, yeah, it's been 30 years in a downtrend, but it's been touched plenty of times over the course of its lifetime, the last 30 years. But that would argue that it's the best answer here. Certainly. Which of the following agrees with the goal of inferential statistics? And these are things Carson went over last week, and it uses the observed data to come to a conclusion about general statistics. So you're trying to infer something from the statistics, and certainly C is the best answer here. Carson, you want to touch on maybe a little more here?
Nope, I think it's said pretty well. The big thing about statistics is just remember that this is on a definitional level. There's quite a few definitions, so just make sure I think a good bit of rote memorization if you haven't had exposure to statistics before, but also trying to understand the concepts behind it. And this is kind of a concept question. What it all comes down to is technical analysis is one of the big things is looking for recurring patterns, right? And so as a trader or money manager, someone who's going to hopefully you can find an actionable pattern, but you not only just want an actionable pattern, but you want one that the tendencies of it, and that's exactly what statistics gives you, not like a hard line. It will work, but it gives you the odds, and you can certainly use that to put the odds in your favor.
Yeah. If you can find a trade that you trade, and has 80% odds, that's probably a very good trade and one you should be taking, and that's what statistics is there to help with. So certainly, letter C gives us the best answer here. A little bit all over the board here. The median defined as, and certainly B looks good as it's the middle number, but it's a randomly sorted set of figures, and that's not what we want when we're talking about the median. We're talking about the middle number in a sequential set of figures. So something sorted low to high, we're going to take the middle point, and that middle point could be off from the average of the set of observations. And then if you have an even number, you're going to take the average of those two in the middle. But the median is certainly the one that's the middle number in a sequential set of figures. Sorry for the typo there, but D is just typed twice there. Yeah, the mean, that's the average. It's the most used measure of central tendency, and you need to know your statistics here to know that what central tendency is talking about, and it's talking about the average, and that's what mean is. So the B, C, and D are certainly not correct answers here. Yeah, again, need to know your statistics for this one. Standard deviation is defined as the measure of dispersion of all collected variables. Now, it's not the cubed root of variance, it is the square root of variance, so B is not correct. And then C and D are easily eliminated because we're not talking about a company's fiscal year return versus its benchmark, or the 1 minus the X root of the number of outcomes. So that gives you something close, I guess, to your degrees of freedom, subtracting out the root there. But, the standard deviation is obviously the best answer.
One thing real quick, too, is
the
a
only
lot of people...
answer.
Yeah. One thing real quick is a lot of people ask me if they have to memorize the equations, and the main thing is a lot of times if you understand the concept, there's less memorization involved. And that was an example of knowing what the equation is kind of helps you with answering these questions. So they're not just pure rote memorization, but there's a little bit of concept in there as well, and that's only going to grow as you head into levels 2 and 3.
Great. Moving on to the next one. Which of the following is not a mathematical relationship between groups of stocks? Where weak positive correlation does not have benefits for diversification. That's actually what we're looking for. We're looking for a weak correlation between a number of stocks, if you will, into a portfolio to get diversification. So that answer is D. Okay, which of the following is not a characteristic of volume? And answer is C. A price rise from a selling climax is by definition accompanied by advancing volume. That's Martin Pring, page 408. Something you're really going to need to know again about characteristics of volume. Yeah, certainly. The Dow theory is concerned with two things. The primary trend of the market. Is it bull market or bear market? And that really is about it. And I guess confirmation. But really, they're trying to determine the trend of the market. Up or down, the size of the trend, the state of business conditions, and the ultimate duration of the trend really don't matter. If you're in a bull trend, you're going to remain in that bull trend until acted upon by another force. And that would be your bearish trend. So you're in a bull, you're in a bear. That's about it. So what's not a measure of central tendency? The mean, the median, and the mode usually always go hand in hand, and variance is the dispersion around that mean. So it's not a measure of the central tendency. Again, you just need to know your definitions here. So variance is the incorrect answer. So the correct answer is because it does not fit the central tendency figures. Well, which of the following is considered a volume oscillator? And that would be the Shaken's money flow. On-balance volume really isn't an oscillator, if you will. I can understand how people would see that, but on-balance volume can continually be positive or continually be negative. It's not really going to oscillate. So you need to know the definition of an oscillator here, and D works best. Yeah, so finally moving into some candlestick pattern questions. Which of the following would not be found at a market top? So you're looking for the one that fits into the market bottom, and the only one that fits is the morning star, meaning brighter days ahead. Evening star, shooting star, hangman, all are bearish signals for candlestick patterns. Don't really need to know exactly how they're constructed, but you do need to know the definitions of them. And a symmetrical triangle, if price continues through the apex, the symmetrical triangle is now in question, and price will most likely just move sideways in a dull drift or ripple or until acted upon by another force, because prices are in equilibrium. They're looking for who's going to be more aggressive, the buyers and the sellers, and price will move accordingly. But until that happens, price will just move sideways. Yeah, so rising relative strength line means that stock is outperforming the market. This is something you're not going to need to know for the exam. Don't confuse it with RSI. It's not what we asked in the question. So we were talking about comparative relative strength, as Ralph Acampora likes to call it. So rising relative strength line on a stock means that it's outperforming its market or benchmark, if you will. Well, the longer a position is held, the more risky it becomes. So which unusual risk concept best describes this sentence? So that's the temporal risk, and that's from Kirkpatrick on page 584. So here, all of the following are true of the head and shoulders consolidation pattern, except, and that would be both B and C. When in a rising market, the volume diminishes on the left shoulder, but increases on the right shoulder. And then in a declining market, it will take the form of a head and shoulders bottom. Certainly not true. Hey, Carson, can you take over for a couple of these real quick?
Sure. Okay, and this one is, again, like we mentioned earlier, flags and pennants are some of the common patterns. So volume is normally very heavy just before, during, and just after the formation of the pattern. You have to see heavy volume on the breakout. Let's see here. And Chris is asking, head and shoulders consolidation, should that have been a continuation? I believe you're right. It's okay, the 3 steps in a stumble theory can be described best as Any guesses on this one? See, that's correct. And then one thing you could do is just by knowing some of the basic things, Wells Wilder had a little bit different approach than looking at these kind of indicators. He actually was more mathematical and had an engineering background. So I think you could eliminate two by just knowing the correct person. Okay, one used logarithmic over arithmetic charting when so the majority got this one correct. Yes, when you're looking at logarithmic, you're more concerned about big jumps in price can distort your view on what it looks like if you're thinking about things in terms of the percentage moves. So logarithmic captures the percent moves all look very similar versus arithmetic where the dollar moves all look similar. Okay, your job as a speculator is to provide liquidity in the market and to counteract the blank excesses of market in motion. That's right, D. Okay, when utilizing moving averages, the disadvantage of the drop-off effect is minimized when using which type of moving average? That's right, the exponentially smooth. And exponential, if you guys recall, will add the more weight towards the most recent price action.
All right, back. Andrew, your question could also be right on the question prior. Linear weighted. I've never really come across that concept, but exponentially smooth is obviously the best answer. So, try and not really worry about what could be right, what can be right. What's the best answer, or what is the answer? All right. I think we're getting close to charts here toward the end that people produced for the class. So thank you for doing that, and then a couple more charts, a couple more of these, and we'll wrap it up. So here, what type of gaps happen near the end of good up or down moves? Really, remember when you're at the end of a move, you've run the marathon. You're at the point of exhaustion. So you just need to know the term here. Breakaway gaps, happen at the start of ones. Runaways when you're trying to get away from the pack in the middle. And common gaps occur, we talked about earlier with, illiquid securities. So the best talking about when you're at the end of a move is your exhaustion gap. Yeah, great question here about candlesticks. Talking about a pattern that starts with a long downtrend on the first day. Second day, gaps open lower on the next day, and then but closes up on the day. Then on the third day, the stock gaps up higher and then closes above the midpoint of the first candle. Here we're talking about the three charts, three-bar pattern, the morning star. And think of it, when you're talking about the three white soldiers, pretty much the same real body. That really doesn't describe what's going on. The evening star doesn't, because we're talking about going up. So now you're down to morning star and the piercing line, and if you know the difference between the two, obviously your answer is the morning star. Yeah, certainly. When prices are rising, volume increase is impressive. It's confirmation of the move. So it's certainly not meaningless, certainly not a divergence. It's not a sign of a reversal, but when trends are in place and prices are rising or prices are falling, volume tends to confirm those moves. Yeah, so your MACD, you need to know how the momentum indicator is constructed, and best answer here is the 12-day and 26-day, and it's the exponential moving averages. So you know the simple moving average, letter C, is incorrect, and then the 12-day and 9-day is not correct. The 9-day is usually the smooth of the MACD. So the best answer here again is A. There, I hope everyone can see it now. Well, here's one. It's talking about different type of candlestick patterns, and we're talking about almost a combination between candlesticks and equivolume charts, if you're familiar with that. And when the width of a real body talks about candlestick, we're talking about the volume. We're not talking about the height of the candlestick, or we're not talking about the height of the real body. We're talking about the width. And this is a tricky question because you need to know what equivolume is too. So if anybody wants to check up on the equivolume, that would help you understand what's going on here. And equivolume is something you may see in level 2 or level 3. Again, you need to know your candlestick patterns here. A 2-day candlestick reversal pattern. Price opens lower on the second day than the previous, but then closes up higher and halfway above the real body. You know this is your piercing line. It's not engulfing either bullish or bearishly, because it's not engulfing at all. It does not close and engulf the previous day's price, and it's not a dark cloud cover, because remember that's a 3-day candlestick pattern. So letter A is correct. certainly, whoops. Sorry about that, ladies and gentlemen. Selling climax is D, a period when high volume and sharp downward movement usually occurs previous to a bull market. So you're seeing prices move on down, and then you see a big move down in price, probably an order of magnitudes of what took place in the previous number of days, and then you got an explosion in volume. And then what happens is everybody who's wanted to sell has sold, and then you usually see a bull market from there on out take place. Sometimes you have a retracement back down to the low of that day when the selling climax takes place, but usually is a little bit higher than the low, but then you start your bull move. So the answer is certainly D. So on here, as we move into the close of our last class here, what is the following as a good test-taking strategy? And the answer is H, all of the above. You're going to do great. You've certainly studied, and attending these classes, we hope, has certainly helped. So don't spend an excessive amount of time on any one question. Use that mark button that we talked about that Prometric uses to go back to any question that you have any doubt about. Maybe sometimes the answers are found in other questions, so guessing early on in the exam might be a little silly. Mark that question, go back to it. You'll find out that, in later questions, because remember they're randomly generated, you might be reminded of something. You'll be able to go back and answer that question correctly. Make sure you leave time at the end to review when you do mark things, and harder questions that you have marked, you'll be able to have time to go back to them. Maybe use that process of elimination that we tried to show throughout the course of the last hour and a half or so, and give yourself the best answer, especially when you're doing like point and figure things. When you see something that says, in a rising column of O's, that's certainly not the answer unless the question is asking for something that is not. Don't panic. Don't drink too much coffee. Certainly make sure you wear comfortable clothes. The exam is, quite long, and certainly believe in yourself. You know this material, and you've done all the required work. There's no reason why you shouldn't be passing this exam. And I guess, lastly, if you do have any questions, certainly email or contact Carson and I, and we'll be available. And then I think, Carson, you want to talk about something really quick before we sign off.
Yeah, I was going to say, I was trying to see if I could finagle my schedule for this weekend, if we have like a review session for, if you guys just have any general questions outside this class, but it might be challenging to do that. In case I'm not able to, go ahead and use the discussion boards. I'm continuously on there. If you're studying or your study group has a question about it, don't hesitate to put the example down and mention it, and we'll get right on it and answer any questions. Typically, those kind of questions come up as you're going through your practice test, if you haven't done that already, or the second one, or as you're honing on the things that are your biggest challenges. So please reach out to us on the discussion boards in this last week or so. Next weekend is the exam on the 22nd, I believe. So certainly make use of those, and keep an eye on the discussion board. If I can free up my schedule, I'll go ahead and let everyone know about that.
Certainly, same thing for me. If anybody would like to have a little conference call on the side, certainly, would be available to do so. Just got to make sure my schedule allows for it. So, earlier the better if you contact us. And, well, everyone, certainly good luck, and thank you for attending the CMTI Institute. We hope you met some nice people, in the organization, when we were certainly proud to pass along our knowledge and experience being technicians, and we hope you continue using the CMTI Institute and enjoy Level 2 and Level 3 with McNeil Curry. Certainly a very knowledgeable person on the subject, someone I had the pleasure of working with for a number of years, and find to be amongst the leaders in technical analysis. So with that, any questions? Certainly get a hold of us however you can. And other than that, any last questions? If not, certainly you're free to sign off. Thank you for participating.